Hi, good day everyone. With me again, Lady Trialdi in Introductory Macroeconomics class. After all the talks about real sector in an economy in the long run, I'm going to explain now about the monetary system or about money in particular. It is important because as we know, money facilitates all transaction in economy and also almost all macroeconomic indicators are expressed in terms of value of money. With money playing a major role in economy, we need to know how the monetary system works. You know, in a common monetary system, there is a central bank or the monetary authority that regulates banks and ensures the health of the banking system, as well as controls the quantity of money in the economy. Moreover, there are banks, important institutions that play a decisive role in the monetary system. So here are what I'm going to explain in this video and the video hereafter. Let's begin with the nature of money. Money basically is any kind of asset widely acceptable by all people in the economy as means of payment. Therefore, the first and the most important function of money is as a medium of exchange. You exchange your money with goods and services you would like to purchase from sellers of the goods and services. How much do you have to exchange your money? It of course depends on the value of the goods and services that you would like to buy. The value, as you already know, is expressed in terms of price, and the price itself is expressed in terms of money. In this regards, money functions as a unit of account. Not only your purchase, your debt, your bank account, and your wealth are all also expressed or valued in terms of amount of money. Now, if you save your wealth, whether in the form of property, clothing, collection of goods, or financial assets like bonds and stocks, basically what you're doing is storing the value of your wealth. You may want to keep or sell them now or in the future. I think you must realize too that you can also store your wealth in the form of a bank deposit or simply money in your wallet. Similarly, you may withdraw your money or use your money now or in the future depending on your needs. Your assets, your money here, serve as a store of value. The value is there for you to keep and use in later or future transaction. About commodity and fiat money, I think no further explanation is needed. The former uses commodity as money, thus money has intrinsic value, while the latter uses others such as paper or coin whose intrinsic value is low or almost non-existent. Okay, after knowing the nature and functions of money, let's talk about money measures in economics or in an economy. It is interesting to know that in the past, paper money is backed up entirely by gold. Remember the story about goldsmith and his warehouse? Printed receipt of the gold storage at the warehouse can serve as money in the society. People truly believe that the receipt represents the ownership of certain amount of gold in goldsmith's warehouse. Then goldsmith realized that normally people will not suddenly and withdraw their gold together at the same time. Because of this, he thought that it is possible to make loan using the receipt of gold storage he printed. As a result, amount of receipt value of gold storage is now more than the actual amount of gold in goldsmith's warehouse. So look here, money is initially backed up by gold in the past, and currently it is backed up by the central bank's net assets. Money that are being backed up by the central bank's net assets are what we call base money or M0. Of course, just like in the goldsmith story, the value of all transaction in the economy is much bigger than the value of M0. What is base money right now? It is the summation of currency and the commercial bank's money stored as reserve in the central bank. Currency is amount of money printed by the central bank, which are coin and paper we hold in our pocket or wallet, and those are held by commercial banks in their vaults. Next, we have M1, or sometimes called narrow or transaction money. It is the most common measurement of money. It is bigger than M0. It includes currency and also all relatively liquid deposit in all commercial banks. Your deposit that can be withdrawn from ATM or can be transferred when you buy something online is one example of such liquid demand deposits. Since M1 includes demand deposits, so whenever more loans and thus more deposits are made, more money will be available in the economy. On the other hand, M2 or broad money is bigger than both M0 and M1. It is M1 plus less liquid money such as time deposits. M2 is broadly used as well, especially when the policymakers would like to see the connection of money to real economic variables. Now, to simplify the explanation about money creation process, we don't specify M1 or M2. Money supply is simply defined as the summation of currency and demand deposits. Furthermore, we also omit the outstanding currency or cash held by people outside the banking system. So if, for instance, the total currency is initially $100, when the entire currency is deposited in one commercial bank, outstanding currency is now zero and the $100 is now in the form of bank deposits. Total money supply before and after no currency are no different. It is still as much as $100. We can express the financial position of the first commercial bank with a T balance sheet account, a simplified accounting statement that shows changes in a bank's assets and liabilities. Here is the T account for first commercial bank if the economist's entire $100 of money is deposited in the bank. The $100 of deposit it received is in its liabilities because that is the amount it owes to its depositors. In its assets, the bank now has reserve of exactly the same amount from deposit it has received. Reserves are deposits that banks have received but have not loaned out. So that's it. With just one commercial bank, with no involvement of the central bank yet, and with no loan has been made, the initial $100 of deposit is the money supply and it doesn't change. How much loan can be made by a commercial bank? Well, it depends on the central bank regulation and the bank policy. The central bank usually sets a minimum amount of reserve commercial banks must hold in the central bank as the fraction of total deposits, called a reserve requirement ratio. The reserve that the banks hold above the minimum requirement are called excess reserve. These excess reserves are the amount that the banks can loan out. How much of the excess reserve are loaned out depending on the individual bank's internal policy. This is how it looks with the first bank's T account initially, when the reserve requirement ratio is, for example, 10% of total deposits. It has $10 of required reserve, or 10% times the total deposits, and $90 of excess reserve. If Bank 1 loans out all its excess reserve, the T account is now like this. See the difference? But of course, it is less clear if I only show you Bank 1's T account. Now, suppose there is a second bank in the monetary system. If the loans made by the first banks are deposited by the borrowers in the second bank, remember there is no outstanding currency in our story, then we have the following T account. Look, here is the $90 loans from the first bank deposited in the second bank. Then it adds to the second bank's reserve. 10% of it is the required reserve as in the first bank, and if no loan is made, the rest is the excess reserve. If we stop here, what is the money supply? Let's calculate the total deposits now. Look, total deposits now are $100 plus $90. Just one loan is made, but money supply already increases. It shows how crucial commercial banks' involvement in money creation process. Worth noting as well, their total reserve in the monetary system remain the same with or without loan. We can imagine that the more involvement of commercial banks in creating loans, the more likely that money supply grows more and more. This is how it looks when we continue the process by including the third bank. Second bank may also loan out all the excess reserve just like the first bank. To make it clear, suppose again that the entire loans are deposited in Bank 3. Even though if those are deposited in Bank 1, the result actually will be the same. Bank 3 then loans out all the excess reserves too. So the process continues with the fourth bank, the fifth bank, and so on and so forth. Total money supply is again calculated by summing all deposits of each commercial banks. But to calculate the maximum amount of money supply that can be created, we can use the geometric series mathematical formula. This is the formula where R is the total reserves, small caps R is the reserve requirement ratio, and 1 per R is called the money multiplier. So, Given the initial reserves of $100 that never change during the money creation process unless the central bank add more best money, then with the reserve requirement ratio of 10% and with all commercial banks loaning out their entire excess reserve, the formula gives us the maximum of money supply totaling $1,000 or 10 times the total reserve. It's clear, the bigger the money multiplier, the bigger the maximum amount of money supply. And since money multiplier is 1 per hour, the lower the reserve requirement ratio, the higher the money multiplier. Here, I would like to show you the overall balance sheet of commercial banks made up from the T accounts of all commercial banks in the monetary system. With initial deposits and reserve of $100, the more and more loans are made, the higher the total deposits. Here is the calculation of total loans if all commercial banks loan out their entire excess reserve. Total loans equal $900. And here is the full calculation of how the deposits are growing, which in short can be obtained by our previous money supply creation formula. Total deposits equal $1,000. Total reserves are $100 with this mathematical calculation, or their amount remain the same. After all the talks about the nature of money and the money creation process with simple commercial banks T account, we may need to know a little bit about the more realistic balance sheet of the commercial banks. The first T account here is what we got before. The second T account, this is what I mean with the more realistic T account, despite not yet complete either. In assets, they are now commercial bank securities other than just loans and reserve. In liabilities, there are commercial banks debt and capital. In this occasion, I only want to show about the additional restriction after the reserve requirement regulation for commercial banks to make loans. The restriction is in the form of minimum capital adequacy ratio, or CAR. CAR is the ratio of a bank's capital in relation to its risk-weighted assets. When the CAR of certain bank is lower than the minimum level, the bank must either increase their capital or reduce their loans. If the latter is chosen, money supply will be lower since less loans means less deposit in banking system, and less deposits mean less money supply. Okay, that's all from me at the moment. After learning about the nature of money and the money creation process, there is one more thing we need to know when we're talking about the monetary system. That is about how the central bank control the money supply and the problem it may be facing. Please watch it in my next video. Thank you for your attention. Good day, everyone.